Good morning. I'm Gord Long with the Financial Repression Authority. As part of our series on risk mitigation, I have Professor Amin Rajan joining us this morning from the UK. Professor Rajan is Chief Executive of Create Research, amongst other things. Welcome back, Amin.
Thank you very much indeed. Good to be back on board again.
Well, you have another great report out. We had you on the last one, and you're truly doing some great work on financial repression and the impact that it has. Amin, could you give our listeners who are not familiar with your background just an overview and Create Research and why you do this research?
Create Research is a UK-based think tank, and every year we poll some 700 top investors around the world in different jurisdictions and in different market segments, and try and find out, what are the key emerging issues and what are the implications for asset allocations made by investors. So our core focus is really on mega themes and their implications for asset allocation. And latterly, we've been focusing a lot on institutional investors because they form an absolute core constituency in our research. And one of the topics that they suggested was financial repression. Their definition of financial repression is something very simple. Financial repression really results from a combination of low interest rates and rising inflation. Authorities are keeping interest rates low so that they can manage their huge debt, which is really getting out of hand at the moment. And secondly, they are trying to stoke up inflation as a way of weaponizing debt. And this kind of combination of low interest rates and rising inflation basically amounts to an arbitrary redistribution of wealth from investors to borrowers. And basically what we're seeing at the moment is this huge redistribution of wealth away from investors to governments and other debtors. So this is an area that we decided to focus on this year because this was number one, number two, and number three issues keeping investors awake at night right around the world.
Well, it's certainly keeping pensioners and savers awake at night who are not making any money. And I don't know if the powers to be are having any success with inflation and getting it up. We seem to have mixed views on just how much deflation we're having on that. But this report, you canvassed 184 different pension plans to manage something like $1.8 trillion here in pensions. And and I have the report up here right now, at least the table of contents. And there's so much in here. We're going to have to just focus down on the areas here I've highlighted. And you've had some various themes because I wanted to get into a clear understanding of what you think the pension plans are thinking of doing, are planning on doing that came out in this report, in this research. And the first one I have up here is theme number 6. Could you help us with that one?
The theme, that thing particularly focuses on pension plans' response, and their key response is really to get smarter at asset allocation. So, doing smarter asset allocation and doing it right is really the number one priority. Now, under this new approach to asset allocation, a number of things are really happening. In particular, 4 things are really worth mentioning. The first one is really that they're taking much more risk in order to get higher returns, because what quantitative easing programs on both sides of the Atlantic have done is really pushed all investors up the risk curve. So they're making the virtue of the necessity by taking on more risk. That's the first thing.
Is that by plan? I mean, is that a strategy, or is that just a default by low interest rates?
Sadly, it is a default option.
Yeah.
It's not their first choice. It's not their last choice. It's their only choice, because the way the bond prices have been inflated and the way the yields are, bond investing has really become very uneconomic for a vast majority of investors. So they're having to go into risky assets.
And haven't that even pushed up the risk in the equity markets also, as they've been at elevated levels? At least we perceive them to be at elevated levels.
Yes, I reckon that risk in equity markets are probably at their all-time high in the current cycle. There's absolutely no doubt about that. We have a lot of what we describe in the report as convictionless trades, in that people are taking risk for the sake of it because they haven't really got any other choice. And as a result, most of them have got their fingers on the invisible triggers. In the event of a big downturn, we can expect huge sell-offs as a result of having a lot of these convictionless trades. But the investors feel that, they've got to be really part of this, because these bull markets can go on for a long period of time. And, they've got to make a choice about taking risk and making some returns, or, being completely left out of what may turn out to be one of the longest bull markets in generations. So taking more risk has become almost the norm. The second one is really trying to look for uncorrelated alpha. There are still a lot of alpha opportunities, particularly in illiquid markets, so they're going into that one. The third one is really about having a very broad diversification, which covers different geographies, different asset classes, and also different ways of investing. And the final one, and perhaps the most important one, is really doing much more periodic rebalancing through dynamic investing, buying on the dips, selling on the peaks, because in today's markets, values opportunities do appear, but they vanish as soon as they've appeared. So there is a tendency to capture value whenever that is available. So this four-pronged approach is really coming into the view now on the part of pension plans around the world.
So, Amin, when I translate this correctly, because we've seen that so many assets now are all correlated, it's very, very difficult now to hedge and with them being all correlated, to find something to protect yourself in case of these drawdowns that come. And pension plans have always used options and various strategies to protect themselves. And now we're seeing, because of course, how difficult that is. And they were never really traders per se, they were long-term holders. But now isn't that forcing them to be in a risk-on, risk-off kind of market and be very nimble? Which means, what I'm getting to, doesn't that mean we could see even dramatic sell-offs and moves in the market because of their reaction?
Yeah, you're absolutely right, God, because what is really happening is that they have been pushed up the risk curve quite involuntarily. And as a result, what the main view is that they ought to really be as opportunistic as possible, capitalize on opportunities as and when they appear, and get out at the first sound of the gunfire, as it were. Now, having said that, these people are really quite smart investors. I wouldn't want to give the impression that they are like day traders in that they're trading very frequently. What they're basically doing is they're rebalancing the portfolios much more now than they've ever done before.
Yes. Mm-hmm.
And your point about correlation, it further reinforces the need to rebalance, because all asset classes seem to be rising and falling in tandem. And as a result, the old style diversification no longer works, and there is a new style diversification which is really taking shape. More about that in a minute. But as a part of this new style diversification, dynamic investing has really become the norm, in that you really have to be very vigilant about where your returns are coming from, how quickly they're materializing, and how nimble can you be in ensuring that you're capitalizing on those returns as and when they appear. Now, as I said, there is a new style diversification emerging. In the past, as you know, diversification was done by different asset classes. You put 60% in equities, for example, 40% in bonds if you were in North America, or the other way around if you were in continental Europe. Now, that form of diversification no longer works because, as you quite rightly mentioned, the correlation between historically lowly correlated asset classes has really gone through the roof, particularly in the down market. Mm-hmm. In other words, diversification doesn't work exactly when you want it. So as a result of that, institutional investors are now moving towards risk factor diversification, in that they're identifying various risks, and then they're identifying assets which will enable them to cope with those risks, and doing asset allocation very much by those risk factors. And something like 40-50% of pension plans are now moving in the direction of risk factor asset allocation. And that's a smart way of investing. So that is probably the biggest and the most enduring legacy of the bear market, in my view.
Yeah, risk has always been a prime concern for all investors and pension plan, et cetera, and are very knowledgeable. But what's happened is this whole area in our assessment of risk mitigation, the risk now, the various types of risks has extended dramatically. Geopolitical risk, event risk, all this has been there before, but now you're into custodial risk. There's trading risks, there's liquidity risk. I mean, we've got a huge grid here at Financial Repression Authority, and any kind of decision that you make investing wise, you've got to actually look at all those elements of risk which are changing. Is that what you're seeing in the pension plan insurance companies?
That's right. Now, what is really happening is that they're really looking at all the factors which contribute to risk in the portfolio.
Yes.
Maybe inflation, it may be policy risk, and then indeed the biggest risk factor at the moment is policy errors on the part of the Federal Reserve in the US. That is
I agree with that, by the way.
That's regarded as the highest risk by investors, because the scope for policy error is absolutely huge. As many governors of Federal Reserve have been at points to point out in the past, that quantitative easing is a journey into the unknown. It is something which we haven't done before, and we don't really know what is the way back from this journey. So that is a really big risk factor. But there are other risk factors as well. China is another one. The future of euro is another one, and so on. So there are these mega risks which are lurking in the background there. And the challenge is to construct a portfolio which actually factors in this risk at the early stage of doing the asset allocation, such that at the downstream end, you don't really need overt hedges or tail hedges to control for the very large risk that may happen as a result of the so-called black swan events. These are the low probability, high impact events. In the past, there was a tendency, for example, to go for stop loss mechanisms or to go for options contracts in order to protect the downsides. But what we're finding now is that there has been so much volatility in the markets that many of these stop loss mechanisms get activated on wrong information. For example, on 6th of May 2010, we had a flash crash in the US. Dow plummeted by something like 600 points, and then it was back to its original level within minutes. But in the meantime, all those stop-out mechanisms were activated on wrong information. And so millions of investors lost billions of dollars because those stop-outs were activated on wrong information. So now the tendency is not really to look for overt hedges, but really to get smart when you're actually constructing your portfolio. And in that respect, the trend towards risk factor investing is a major development.
Theme number 7, you talk about idiosyncratic risk. Could you help us understand that one more better?
Okay, so this really goes back to your previous point that correlation between asset classes have risen very significantly indeed. So diversification really doesn't work in the way that it is supposed to work. Secondly, we also sort of find that all asset classes are highly inflated in values simply because of central bank action. And so what we find is that the real returns come from identifying value opportunities. Mm-hmm. And so the idea is really to look for individual opportunities at the most granular level and understand those opportunities and then decide whether to capitalize on them or not. So idiosyncratic risk is sort of very much about looking at very specific investment opportunities when you've identified them, assessing their risk parameters, and then making a decision about whether to go for it. This broad brush approach where you just invested in equities and bonds on the basis of 60-40 formula, that approach just doesn't work at all. You've got to be much more granular. And this idiosyncratic risk is really understanding the risk parameters of those specific opportunities that you've identified.
Would that take, would that take the form of even not necessarily being in stocks and bonds, or therefore in the publicly traded exchange items, maybe being in private placements, private venture capital, other areas that have traditionally not been their venue?
Yeah. Yes, it may mean that. For example, one of the most interesting developments of the last 5 years has been the rise of private debt as an asset class.
Yes.
Now, private debt in the past was sort of regarded very much as a Cinderella asset allocation class, simply because it had a negative image that the companies who were private borrowers were the ones who nobody else wanted to touch, and therefore they had to really do a deal directly with investors. Now we find that private debt has really become a mainstream asset class. Now in private debt, each items, each investments are a special vehicle which involve huge amount of due diligence. And they are the best example of managing idiosyncratic risk, because everything about individual companies who are out in the market trying to raise money, everything about them is scrutinized at very granular level indeed. So idiosyncratic risk is sort of fundamentally very much looking at the parameters of every investment that you are making and understanding what are the inherent risks and what are the inherent opportunities, and what are the best ways of minimizing those risks and maximizing on those opportunities.
So areas such as distressed debt, which
Yeah.
is growing, has never been the purview of pension plans, but we may see them starting to look at that as an investment class. Is that a possibility?
Yeah, it is a possibility indeed, Gordon. It's already happening.
Okay.
We have been tracking the asset allocation approaches for the last 7 years. And, it is one of the asset classes which has really gone up very high on the list of institutional investors. Distressed debt, for example, high yield is another one, private debt is another one, infrastructure, real estate, all these are illiquid asset classes, and they've all raised up on the agenda of institutional investors. So we are indeed seeing interest in asset classes which were sort of previously regarded as untouchables.
And so things like you mentioned infrastructure, they would consider that as real tangible asset that's protecting their underlying investment. So even though they hadn't been in it before, they would be looking at it now strategically. Is that a possibility?
No, and that is indeed happening as well.
Okay.
And infrastructure as an asset class is definitely gaining traction. There's no doubt about it. Having said that, I think it's worth pointing out that the interest is very much focused on listed infrastructure rather than private infrastructure, because private infrastructure invariably involves government as one of the counterparties. And as you know, governments have a nasty habit of changing the goalpost halfway through the agreement.
You can almost count on it, actually.
Yeah. So as a result, institutional investors have not really been very keen on anything other than listed infrastructure. And allocations to listed infrastructure are rising. I reckon in the pension space, something like $1.5 to $2 trillion worth of investments have been made into infrastructure in the last 5 years or so. And it's an asset class which is likely to grow over the next 3 to 5 years, according to our forecast. So yes, investors are going away from traditional asset classes into more illiquid asset classes or more esoteric asset classes in search of higher yield. There's no doubt about it.
I mean, in your allocation section, you've got some great charts. One is that you think that the markets are going to stay jittery as long as debt stays high. And I've got a chart up that shows you some factors on that. Could you help us with that chart?
This is
Figure
yeah,
4.1.
4.1. Yes, sure. Now, what we tried to do before asking individual investors about their asset allocation approaches, we tried to find out, what do they think will be driving the markets over the next 3 years or so. And quite unexpectedly, growth in global outlook and growth in global European economy, they've really sort of come right at the top there. And then there are also worries about currency wars. Since the beginning of last year, we've had 25 nations around the world who have devalued their currencies. So, there is a de facto currency war going on, and its effect could be really quite devastating, especially if large nations like China start engaging in it, as it seems likely to be going to do. And then, things like aging demographics, these are really having a major effect on the funding levels of pension plans, because the post-war baby boomer generation, many of their members are now coming into retirement over the next 7 years. We've got some 78 million Americans retiring. We've got some 84 million Europeans retiring, and so on. So we've got a large number of baby boomers coming into retirement. And this is really going to change the asset allocation approaches of pension plans or of individuals who are managing their own funds and so on. And so basically, the global economy, its outlook is what is uppermost on the minds of investors, because quantitative easing programs, insofar as they've helped US and UK more than any other countries. And even in US and UK, economic growth is subpar. And so there is real worry that current market valuations are well above where they should be, unless there is strong economic growth coming back, which would then help to inflate, to boost earnings and justify the current earnings multiples. At the moment, the multiples are too high. So growth is what everybody is looking for, and growth is something which really keeps people awake at night, next to the idea about financial repression.
So with this in mind, and also this shift from asset management to risk management, in your survey you asked what the pension plan's aims would be over the next 3 years. And I have that chart up. Could you help us with that one? What you learned from it?
In the light of these mega developments, the two key ideas that these pension plans have is, one of them is really to have an intelligent asset allocation. Don't follow the herd. Don't follow a formulaic approach. Look at your liabilities. Make sure that you're investing with both your eyes firmly focused on liabilities. So do asset allocation which fundamentally addresses your long-term liabilities, and that's one of them. The second one is, insofar as good returns are going to come from idiosyncratic forces, try and engage in dynamic investing. Identify opportunities, identify value traps, learn to know the difference between the two, take advantage whenever the opportunities arise, and be fleet of foot. So that's the second aim. And the third, and very important aim as well, is go for consistent returns and also capital protection. Because if a pension plan sustains big losses now, it'll take a long time for them to recoup those losses, because we have now entered a low return environment, and this low return environment, they cannot afford to take big hits. So consistent return and capital protection has really raised up the agenda as well. And the fourth one is, unsurprisingly, healthy funding levels. At the moment, the funding levels are not really good in any part of the world apart from Canada. In the US, average funding levels in the private sector are about 78. It's about 70 in the public sector. Numbers not very different in UK, and not very different in Japan and other markets and so on. So, having healthy funding levels has also become extremely important. So these are some of the objectives that they're really trying to pursue. But the key one is, try and be a smart investor. Don't do what you've done in the past, because that is a recipe for disaster.
We had drawdowns after the dot-com bubble in 2000. We had drawdowns after the financial crisis. But we also had, because of the dramatic stimulus, rebounds in those equity markets. So holding on, you were all right. But if we're going into a sustained low return, minimal kinds of investment returns, then a drawdown that if we had now, you may never recover from it. So this is a heightened risk period compared to even 2000 and 2008. Am I drawing the right conclusion there?
Absolutely spot on, my friend. Because what has really happened is that quantitative easing program inflated asset values, both equities and bonds, and that really saved the day. Now we've got into a situation where these asset values are not sustainable.
Right.
In the light of the economic performance in the last 2 years or so. We hope that growth will resume. We hope that there is no hard landing in China. We hope that Japan picks up, and so on. But if these hopes don't materialize, then we will be in a situation where the current valuations will be very hard to sustain, and we could be looking at another major correction. There are analysts who really believe that we are in the early phase of a bear market now. Certainly since the start of this year, the kind of jittery markets that we've seen, they are not a one-off thing, because growth is slowing down everywhere. In Europe, we're talking about another round of quantitative easing. In Japan, they're thinking about another quantitative easing. And the biggest worry in all this is really that this drug, it worked in the beginning, but for it to work again, we have to come out with bigger and bigger doses. And our policymakers cannot come out with bigger and bigger doses because, national parliaments, particularly here in Europe, are not really very happy about what the European Central Bank is trying to do in this area, for example. The same thing in Japan, that there's a lot of disquiet about quantitative easing. So we're in a situation where a lot can go wrong, and as a result, capital conservation is very important because it takes a long time to recoup the losses in today's environment.
The last chart I'd like to put up here is this from macro risks to idiosyncratic risk, and it's what the pension plans felt were going to be the areas that they were looking at. Could you help us with that one?
Yeah, sure. So I mean, what we basically did was, we had a list of all those asset classes, and we said, so amongst these asset classes, which ones are you likely to favor most? And so that was a betting order that really came out, global equities and real estate right at the top there. The second question that we had was that within these asset classes, are you really going to use these asset classes as in the same ways that you've done in the past, which is to say, as long as I'm invested in global equities, I'm going to be okay? Or are you going to be much more selective? And the answer here was a definitive selective. We're going to go very selective in the way we invest in global equities and in real estate and so on. Now, you remember that it used to be said that, fixed asset allocation and numbers would follow. And it was believed that something like 90% of returns come from doing the right asset allocation. Nobody believes that anymore. If we believe in that, we only think that something like 50% of returns come from right asset allocation calls, and the other 50% really comes from making the right choices of specific securities. So this could be the age of stock pickers. We are moving in an era where stock picking is likely to become far more important than it has been in the last 15 years that I've been writing about investment matters.
Certainly, and certainly for those in the institutional fields of insurance and pensions, etc., who've never really saw themselves as stock pickers, more as asset allocators, and they're going to have to develop new skills. Now, the last chart I wanted to show is on your theme number 8, and you're suggesting that the asset managers are going to need to raise their game.
Yeah, that's right. Now, this has been a supply-led industry, as you know. Asset managers have never really had to struggle very hard in order to sell their wares. Markets do a great job for them. So we had a bear market at the start of the last decade, but then it lasted for about 2 years. The markets bounced back. Then we had another bear market with the onset of the Lehman collapse. And, that lasted for about a year or so. And, central banks stepped in and markets recovered. Now there is this feeling that, we are entering a long period of low returns because central banks have done what they could possibly do. That drug isn't going to work second time round, third time round in a way that it worked first time round. It's losing its potency. So what asset managers need to do is really have their business models change in 3 fundamental ways. One of them is that they need to get much closer to their clients, understand clients' dreams and nightmares, understand their risk profiles, do client perceptions surveys, identify, whether clients are being sold products that they need rather than the products that asset managers have got, and so on. So client focus is an area which is really receiving a lot of attention at the moment. The second area is investment capabilities. At a time when markets are so distorted, what does it mean to be an investment professional? It's a hard question to answer. And my answer to that question is that today's smart investment professional should really know the difference between value traps and value opportunities. All that glitters is not gold. The fact that, for example, markets have fallen in emerging markets doesn't necessarily mean that that's a big buying opportunity. A smart investor knows that emerging markets have a very strong price momentum, such that it has a tendency to have prices falling for much longer than is justified by fundamentals. So understanding value traps, value opportunities is important. The second thing is really understanding the correlations at different phases of the market cycles. That yes, correlations are rising, but what we also find is that there are different regimes emerging, where under certain regimes correlations are higher, under certain regimes they are lower. So really learn to understand what those different regimes are, and then devise your portfolio accordingly. So investment capabilities are very important as well. And the third one is alignment of interest. Asset managers need to eat their own cooking, which basically means a strong financial alignment of interest. Having either performance-related fees, or really making sure that they don't really they're not in a situation of a fee structure which basically says heads I win and tails you lose. Fee structures need to be much more meritocratic. Secondly, the innovation processes that asset managers have got need to be fit and proper. Products need to be tested and tried before being brought to the market, and so on. So a good fund manager will really pay a lot of attention to all those three factors. Indeed, I hasten to add that the asset manager business models are probably going through the biggest makeover now. And each of these areas is receiving far more attention than that they have done over the last 15 years. So if asset managers really want to be their clients' trusted advisors, if they want to be part of the inner circle of advisors of their clients, they really need to make sure that they've got very strong client centricity, good investment capabilities which are consistent with today's harsh reality, and a very strong alignment of interest, which suggests that we're all in this together. It's not heads I win, tails you lose, which was the case in the past.
I mean, there's just so much in this report, and it's absolute must reading for everybody, any investor to go through a lot of the research and feedback. Is there any overall from the report? Is there any key messages you'd like to leave with our listeners here today on it?
I guess my parting thought for the day would be that you in today's environment you have to remain invested, because the current market situation may get better, it may get worse. You have to keep an open mind. That basically means that you need to really be very smart in the way that you do your asset allocation. Use as much common sense as you can. Road test your ideas, stress test your ideas with a lot of people before you actually make asset allocation calls. But most of all, don't follow any specific formula or any specific template, because none of those formulas or templates work in today's environment. We're on a journey which is truly a journey into the unknown.
I mean, can you tell our listeners how they could download this report, where they would go?
It could be downloaded from our website, which is www.create-research.co.uk.
Thank you very much. We're going to have you back. I really appreciate the time and joining us here this morning. And thank you. Thank you very much.
Thank you, Gordon.
Talk to you again. Bye-bye.
Thank you. Bye-bye.